Welcome back to the Deep Dive. It is Wednesday, February 4th, 2026.
Good to be here.
And if you are checking your terminal today, you're probably seeing a sea of red and green that, frankly, it doesn't make a lot of sense at first glance.
Especially if you track the Indian consumption story.
Exactly. We are literally hours post the Q3 FY26 earnings calls for the major QSR players. The transcripts are just out, and to put it mildly, they're dense.
They are. A lot to unpack.
But this isn't just about quarterly noise, is it? We're here to do what Druva Investors expects us to do. We're here to strip the paint off the walls and, look at the structural integrity of the house.
That's the mission.
And today, that house is the quick service restaurant sector in India.
And it feels different this time. Usually when we talk QSR in India, we fall back on the same things. It's the long runway, it's demographic dividends, all the standard bullish macro stuff.
Right. The big picture story.
But today feels different. The landscape has fundamentally shifted in just the last 30, maybe 40 days. We're not just looking at earnings anymore.
Right. No.
We are looking at a consolidation event that completely changes the power dynamic of the entire industry. And we're looking at a war, and I really don't use that word lightly, a war between the food brands and the aggregators that has finally reached a boiling point.
It really has. Okay, so let's lay out the source stack for everyone. We have a massive pile to get through. We've got the fresh Q3 transcripts that literally dropped this afternoon.
Hot off the press.
We've got the merger documents from the Devyani Sapphire deal that was announced in January. We've got the annual reports from Westlife and Jubilant, which give us the bigger picture.
And that scorching report on the aggregator versus QSR conflict, that's a must-read.
It is, but let's not bury the lead here. The elephant in the room, the thing that changes everything. The merger.
Devyani International and Sapphire Foods.
The two biggest franchisees of Yum brands in India are becoming one. This is the headline event, absolutely.
It's tectonic.
But I want to push back on the sort of celebration narrative immediately, right out of the gate. I've been looking at the swap ratio. 177 shares of Devyani DIL for every 100 shares of Sapphire, SFIL. Now, on paper, if you're a Sapphire holder, you're getting a nice little premium. But the market reaction, it hasn't been this euphoric pop you'd expect from a clear arbitrage opportunity.
It's been muted.
It feels like the street is pricing in a massive integration risk. So the question for us is, are we looking at a 1 + 1 = 3 scenario here? Or is this just a 1 + 1 = 2 and a whole lot of headache scenario?
And that is the skeptical investor view. And you know what? It's a valid one. M&A in India, especially when you have these big promoter-driven entities, it's messy. It's always messy.
Always.
But you have to look at who is pulling the strings here. This is the RJ Corp playbook. This is the Jaipuria family. If you look at what they did with their bottling business.
Right, with Varun Beverages?
Exactly. Consolidating all those fragmented territories into this one monolithic operation. They have a proven track record of squeezing out operational synergies that you just can't see on day one.
So the market is just being patient, or impatient, rather.
The market is hesitant. Because integration takes time. It's usually an 18 to 24-month story before you really see it show up in the EBITDA margins.
Yeah.
But the strategic logic here, it isn't just about saving a bit of money on HR or, buying napkins in bulk.
Okay.
It's about creating what we should call the monolithic entity.
Explain that, because my first thought is competition between franchisees usually keeps them sharp, right? Yum brands, the parent company, they usually like having a couple of big franchisees fighting for territory because it drives volume and keeps them on their toes. Why would Yum sign off on creating a franchisee that is, for all intents and purposes, too big to fail?
And that's the real nuance here. You're right. In a high-growth, blue-sky market, fragmentation works perfectly. Let them fight it out. But in a maturing market that's facing serious headwinds, which, let's be honest, we've seen for the last 4, maybe 5 quarters, that fragmentation becomes weakness.
How so?
Because they start undercutting each other on price, on promotions. It becomes a race to the bottom that hurts the brand. By allowing this merger, Yum is essentially acknowledging that they need one single, powerful partner with a balance sheet big enough to weather the storms.
Not two smaller partners bleeding each other dry.
Precisely. The combined entity is going to control over 3,000 stores. Just think about that number. That's not a franchisee anymore. In the QSR map of India, that's a sovereign state.
A sovereign state that can finally negotiate. And this brings me right to the leverage point. We've seen EBITDA margins under pressure across the board. Look at Sapphire's Q2. That consolidated net loss of almost 13 crore rupees, that was a nasty surprise.
That was a shocker. driven entirely by those demand headwinds.
So my question is, how does merging fix the demand problem? You can have 3,000 stores, but if people aren't buying fried chicken because inflation is pinching their wallets, well, you just have 3,000 emptier stores.
Correct. And that's the key distinction. The merger doesn't solve the demand problem directly. That's a macro issue. That's an RBI issue.
Okay.
What it solves is the cost structure problem. And specifically, the line item that's been killing everyone, the aggregator tax. This is the real aha moment for a Druva investor.
So it's all about fighting Zomato and Swiggy.
Think about it. When Sapphire goes to Zomato to negotiate commissions, they're big, they have some leverage. When Devyani goes, they're also big. But when the combined monolithic entity goes to the negotiating table, representing the vast majority of all KFC and Pizza Hut volume in India,
That's a completely different conversation.
completely different. They can demand lower take rates, they can demand better data sharing. It flips the power dynamic, it completely turns the table.
So what you're saying is it's a unionization of capital.
That's a great way to put it, yes. It's creating a necessary counterweight to the aggregator duopoly.
Let's stay on the financials for just a second before we jump fully into the aggregator wars. You mentioned Sapphire's loss. Devyani is also seeing muted demand, but their transcript talks a lot about pivoting to boneless chicken and these digital kiosks.
Yes, the kiosks are a big part of their strategy now.
I want to drill down on that kiosk CapEx. They've rolled this out in 238 restaurants. I see the analysts on the call cheering this as modernization, but isn't this just masking a traffic problem?
How you mean?
Well, if I'm spending capital on a fancy screen to upsell an extra Coke to the same guy who's already in my store just because I can't find a new guy to walk through the door, isn't that a quality of earnings red flag?
If you look at it in a vacuum, I can see that argument, maybe. But you have to look at the unit economics of a kiosk order versus a traditional counter order. The data from international markets is clear, and we're seeing it in Westlife's numbers in India too. The average ticket size, the ATS, on a kiosk order is consistently 15 to 20% higher.
15 to 20, that's a lot.
It is. The machine is a ruthless, shameless, brilliant cross-seller. It doesn't get tired. It doesn't judge you for ordering a McFlurry at 11 in the morning. It will always ask if you want to make it a large.
Okay, that's a fair point.
So even if your footfall is flat, if you can drive your ATS up by 15% just through a tech intervention, you're protecting your store-level EBITDA. It's a defensive play, for sure, but it's a highly effective one.
So the strategy is mine the existing customer for more yield because new customer acquisition is getting too expensive.
Exactly. And why is acquisition so expensive?
Because the gatekeepers have raised the toll.
Because the gatekeepers Zomato and Swiggy have raised the toll.
Which is the perfect segue. Let's talk about the great decoupling. I read that report you flagged, and the language in it is incredibly hostile. I mean, it calls the relationship between QSRs and aggregators a zero-sum war of attrition.
It is.
That's a huge pivot from the symbiotic partnership narrative we were all hearing back in, 2023, 2024?
The symbiosis is dead. It officially died the moment the aggregators achieved market dominance. When you have Zomato sitting at 55 to 58% of the market and Swiggy with the other 42 to 45%.
A classic duopoly.
It's a textbook duopoly. And when that happens, the pricing power shifts entirely to the platform. We're seeing take rates, the commissions creep up year after year. We're seeing new platform fees being added on the consumer side. It's a double tax.
Explain that. A double tax.
It suppresses demand by making the final meal more expensive for the person eating it, and it simultaneously suppresses the restaurant's margin by taking a huge cut of the revenue. It hurts both ends.
But the financial cost is just one part of this war. I want to talk about the data masking. To me, as an investor looking at long-term value, this is the scariest part of the whole story.
It's the existential threat.
If I buy stock in a restaurant chain, I'm buying their brand equity, sure, but I'm also buying their customer relationship. But if Zomato actively masks the phone numbers and identities of the customers placing the orders, doesn't the restaurant chain just become a glorified ghost kitchen with a recognizable logo?
That is the commoditization trap. That's the end game for the aggregators. Customer orders a burger on the app. The restaurant gets the order details. One burger, no pickles, delivered to this address.
But they don't get the who.
They don't get the who. They have no idea if this is a first-time user they should try to wow, or a whale who orders 3 times a week. Without that data, you cannot calculate customer lifetime value, CLV. You can't do cohort analysis. You can't remarket. If that loyal customer stops ordering one day, you have no way to reach out and say, hey, we miss you, here's a coupon, please come back.
You are completely flying blind. It's terrifying. And what about Zomato's opt-in data sharing thing from late 2025? The National Restaurant Association of India, the NRAI, they basically called it a tactical bluff to avoid antitrust regulation.
Because it is. It's a token gesture to placate the CCI. The aggregators know perfectly well that data is the new oil. They're building their own moats. Look at their strategy. They're launching quick commerce for groceries.
Blinkit, Instamart.
Right. And more importantly, they're launching their own private label food brands. Why on earth would they hand over the precious customer relationship to the QSRs when their long-term plan is to eventually sell their own private label burger to that very same customer?
That is a chilling thought if you're a QSR shareholder.
Hmm.
Okay, but let's look at the direct P&L impact. We have a breakdown of a standard 500 rupee order. I want to walk through this because the spread between the two models is just shocking.
It is the math that defines the entire sector right now. So let's take your standard 500 rupee order. In the aggregator model, first you have the commission. Let's be generous and average it at 24 to 25%.
Okay, so that's 125 rupees gone right off the top.
Gone. Then you have payment gateway charges, listing fees, sometimes a discovery fee if you want your restaurant to show up at the top of the search feed. By the time that money actually hits the restaurant's bank account, they're netting about 315 rupees.
Wow, so nearly 40% of the top line just evaporates before you've even paid for a single potato or a slice of cheese.
Correct. Now, let's look at the direct model. This is where the restaurant uses a tech stack like Thrive or .p, or more importantly, their own branded app. The commission is gone. You pay a small SaaS fee for the tech, maybe a third-party logistics fee for the delivery rider from a service like Shadowfax or Dunzo.
And the net on that?
On that same 500 rupee order, the restaurant nets somewhere between 395 and 435 rupees.
That's an 80 to 120 rupee delta per order.
That delta is the entire net profit margin. On the aggregator channel, many QSRs are essentially just trading dollars for pennies to keep the kitchens busy and maintain some top-line momentum.
But on the direct channel, they're actually making real money.
That's where the profit is. And that is why you see this absolute desperation from the big players to build what they're calling their digital moats.
But is it working? I mean, can anyone actually break the duopoly? I see these disruptors trying. Rapido is entering the fray with a fixed fee model, 25 rupees flat fee for orders under 400. That sounds great for the restaurant.
It's a game changer for their P&L.
But can Rapido sustain that?
Uh-huh.
Or is it just another venture capital subsidized cash burn to acquire market share?
It's a fundamentally different model, and that's why it's interesting. Rapido is utilizing an existing fleet that has downtime. Their bike taxi fleet is already on the road. The marginal cost of adding a food delivery to a rider's route is much lower than building a delivery fleet from scratch.
So they're sweating an existing asset.
Exactly. And the fixed fee model itself, turning a variable cost, the commission, into a fixed cost, the delivery fee, is revolutionary for restaurant economics. If your average order value is high, a percentage commission absolutely kills you. A 25 rupee fixed fee is negligible.
It could work.
If Rapido can execute on reliability and delivery times, and that is a very, very big if, it could force the big aggregators to rethink their take rates. But for right now, let's be clear, it's a David versus two Goliaths situation.
And while the Davids are figuring it out, the Goliaths of the QSR world are building their own fortresses. Let's talk about Jubilant FoodWorks, Domino's. They are the original own fleet guys. They've been doing this for decades.
They wrote the playbook.
But I'm looking at their 20-minute promise pivot, and I have to play devil's advocate here. Asset turnover is great, I get it. But splitting territories to get closer to the customer? That sounds like capital suicide in a slow demand environment. Why would you build a new store 2 kilometers away from an existing one when your same store sales growth is already sluggish? Aren't you just stealing sales from yourself?
You are, 100%. It's textbook cannibalization. And if you look at Jubilant's SSSG numbers over the last few quarters, they have been soft. The market has punished them for it every single time.
Yeah, so why do it?
Because you have to look at the time frame for their fortress strategy. Jubilant isn't optimizing for Q3 of fiscal 26. They are optimizing for fiscal 30. By splitting the territory, yes, they cannibalize the old store's sales in the short term, but they slash the average delivery time from 30 minutes down to 20.
But does 10 minutes, does that really matter that much to the consumer? Is that the hill to die on?
The data says yes, absolutely. Customer satisfaction scores, their NPS, it spikes. But even more importantly, the rider efficiency spikes.
Okay, that's interesting.
If a rider can complete 3 deliveries in an hour instead of 2 because their delivery radius is smaller,
Hmm.
your cost per delivery plummets. You're sweating the asset, the bike and the rider, much, much harder. And crucially, you are blocking a competitor from opening a store in that gap you've created.
Ah.
If Domino's doesn't open that new store, you can bet a Pizza Hut or a local player will eventually move in. It's a defensive land grab disguised as a service improvement.
So it's about density as a moat. That makes sense. But let's talk about another part of their moat. The loyalty program. Cheesy rewards. I'll be honest, I usually roll my eyes at these programs. They feel a bit gimmicky.
Most of them are.
But the Net Promoter Score data they shared here is fascinating. You're saying loyalty members are actually more forgiving of mistakes.
This is pure behavioral economics at play, and it's brilliant. The data Jubilant shared internally shows that a loyalty member, someone who is actively collecting points for a future free pizza, has a significantly higher tolerance for service failure.
So if the delivery is late,
If the pizza is late, or it's raining heavily, and they pause deliveries for an hour, a non-member gets frustrated. They might delete the app and just open Zomato to order something else. A loyalty member waits. They have a sunk cost in the form of their points. They don't want to lose progress.
it's an emotional buffer.
It's an emotional buffer that is priceless in a logistics-heavy business where things are guaranteed to go wrong all the time.
And in financial terms, it effectively lowers their customer acquisition cost to zero for all repeat orders, while their competitors are paying Zomato a 25% tax every single time to reacquire that same customer.
Precisely. That is the engine. And they're using the cash flow from that engine to fund their next big war, Popeyes.
Right. Popeye's fried chicken. So Jubilant is now going head-to-head, directly challenging the new Devyani Sapphire monolith in the fried chicken space. Is this a real threat? I mean, KFC is practically a religion in many parts of India.
It is a massive threat. And the reason is execution capability. Jubilant understands the science of delivery better than anyone else in this country. If they can apply that Domino's playbook, the 20-minute promise, the dense store network, the owned fleet to fried chicken, which traditionally doesn't travel as well as pizza,
It gets soggy.
gets soggy. If they can solve that, they can crack a market that KFC is essentially owned by default for years. And we're already seeing them scale up the Popeye store count very rapidly. It's going to be a bloodbath for market share in the chicken segment over the next 2 years.
A bloodbath I will be watching very closely. Now, let's pivot to a company that seems to be taking a completely different, almost opposite approach. Westlife FoodWorks, McDonald's in the South and West. While Jubilant is obsessed with velocity and delivery times, Westlife seems to be obsessed with potatoes.
It sounds funny when you put it like that, but yes, the Santana potato is a very serious competitive advantage.
I know. It's their barbell of innovation and sourcing. But you have to explain to the listeners, why does a specific variety of potato grown in Gujarat actually matter to the stock price of a burger company?
It matters because of the gross margin line item. French fries are an incredibly high margin attachment product. Most global QSR chains operating in developing markets have to import high-quality frozen fries because the local potato varieties just don't have the right solid content or texture.
So they're exposed to import costs.
When you import, you're exposed to currency fluctuations, global shipping rates, tariffs, geopolitical supply shocks, you name it. Westlake spent years, decades, almost working with McCain and farmers in Idar, Gujarat, specifically in the black cotton soil regions, to localize the cultivation of this Santana potato variety.
So they've effectively built an import substitution moat.
They source 99% of their ingredients from within India. When the rupee depreciates against the dollar, Westlife's cost of goods sold, their COGS, remains relatively stable. Meanwhile, their competitors who rely on imports are seeing their costs spike. That stability allows Westlife to hold its price points without bleeding margin.
Which brings us to their pricing discipline. This is a key part of their story. Westlife has been very vocal, very clear about not playing the deep discount game on the aggregator platforms. They'd rather lose a sale than cheapen the brand.
That's their line in the sand.
In a hyper-price-sensitive market like India, isn't that just arrogant? Isn't that a recipe for losing market share?
It's extremely risky. And to be fair, they have lost delivery market share because of it. Their delivery growth numbers have lagged behind peers who are discounting aggressively on Zomato and Swiggy.
So the bears have a point.
They do. But the strategic discipline argument from management is that once you train a customer to only buy your product on a 50% off discount, you never get them back to paying full price. You've destroyed your own brand equity. Westlife is trying to protect that. They're pushing the phygital experience instead.
Phygital. Physical plus digital.
Right. They want to get people into the store, using the McDonald's app for offers, using the self-ordering kiosks.
Oh, I saw that number, 75% digital-led sales. That's a staggeringly high number.
It is. And a huge chunk of that is digital orders placed inside the physical restaurant.
Mm-hmm.
They want to own the customer relationship in the venue. They're making a bet that the holistic experience of a modern McDonald's, the clean restaurant, the McCafe coffee, the table service, is a real differentiator that pure delivery can never match.
Yeah.
It's a bold bet on the physical world in an increasingly digital age.
It's a very bold bet. But speaking of bets, let's look at the company that feels like the ultimate turnaround bet right now. Restaurant Brands Asia, RBA, Burger King.
The turnaround kid.
For years, the thesis on RBA was simple. Growth at all costs. Burn cash, build stores, grab land. But looking at this quarter's numbers and the management commentary, the entire narrative has flipped on its head. They're cash flow positive. Positive EBITDA.
It is one of the most impressive strategic pivots we've seen in this sector in a long time. The market was relentlessly punishing them for the cash burn. And to their credit, management listened. They shifted the company's focus from being infrastructure builder to a cash flow generator.
But how did they do it so quickly? Did they just slam the brakes on opening new stores?
They definitely slowed down the pace of expansion, yes.
Yeah.
But the real story, the amazing part, is how they grew their sales. We talked about how other peers were hiking prices aggressively to offset inflation.
Right.
RBA didn't really do that. Their growth was traffic-led. Their same-store sales growth was a positive 2.8%, and that was driven by more people walking in the door, not by charging the same people higher prices.
And that's the famous barbell strategy on price architecture they talk about. The super cheap deals at one end and premium at the other.
Yeah. Exactly. The 2 for 79 rupees and 2 for 99 rupees deals are the magnets. They bring in the college kid, the Gen Z consumer, who is incredibly value conscious. You make very little, maybe even zero margin on that specific transaction. But you get the footfall. You get them in the door.
And once they're in?
Then you have the King's Collection, and the limited time offers like the Korean Fest burgers at the premium end for the customer who's willing to spend more. This tiered price structure allows them to capture the entire demand spectrum, from the most price-sensitive to the most indulgent.
But the thing that really caught my eye in their investor presentation was the section on operational engineering, the broiler innovation. This is the kind of granular detail I absolutely love.
It's fascinating, isn't it? This is where the real deep dive happens. They rolled out a new type of broiler. That's the machine that grills the Whopper patties, that consumes 50% less energy than the old model.
50% is a huge number. That can't be a typo.
It's not. It's a massive technological improvement. In the QSR P&L, utility costs, electricity, gas, are a significant line item. It's usually around 3 to 4% of your total sales. RBA is explicitly targeting a 1% reduction in utility costs as a percentage of sales.
So they want to take it from, say, 3.5% down to 2.5%.
Correct. Through these new broilers, new energy-efficient e-coolers, and even simple things like installing window blinds to reduce the air conditioning load in the summer.
And for a business that operates on razor-thin net margins, saving 1% of your entire sales figure on your electricity bill is...
It flows straight to the bottom line. It is pure, unadulterated profit. That 1% could easily be the difference between posting a loss and posting a profit in a tough quarter. It shows a culture of operational excellence and cost consciousness that, frankly, wasn't there 3 years ago.
And at the same time, they're finally cleaning up the mess in Indonesia.
Yes. Closing 36 unviable stores. Taking a knife to the corporate overheads there, they're stopping the bleeding from that subsidiary. And that sends a powerful signal to investors that management is willing to make the tough, unpopular calls to protect capital and focus on profitability.
So if we pull it all together, we have 4 very different stories. We have the consolidated giant in Devyani Sapphire, built for leverage. We have the digital fortress in Jubilant, built for customer ownership. We have the disciplined localizer in Westlife, built for margin protection. And we have the efficient operator in RBA, built for cash flow.
Very good summary.
But I want to zoom out to the macro level for a moment. We keep hearing these big bullish themes: densification, urbanization. But let's be real for a second. If same-store sales growth remains low, if people on an aggregate level just aren't eating out as much because their wallets are tight, does any of this individual company strategy matter? Are these stocks just value traps in a structurally slow market?
That is the big fear. That's the bear case. And it's not an unreasonable one in the short term. But you had to look at the demographic chart of India versus the rest of the world. Our median age is 28.7 years.
So young.
Incredibly young. Japan's median age is 48.6. China is heading towards 40. We're a young country that is still rapidly urbanizing. The structural shift from the unorganized sector, from street food to the organized QSR sector, is a secular trend that spans decades, not just a few quarters.
So you're saying the current slowdown is cyclical, not structural?
I believe so, yes. High food inflation hurts discretionary spending. That's a cycle. But the habit formation is happening every day. A whole new generation is growing up for whom ordering a pizza or a burger is a normal, regular part of life.
And the densification dilemma, the cannibalization we talked about with Jubilant.
That looks bad on a quarterly spreadsheet today because it dilutes a per-store sales. I get it. But it is the only way to build the necessary infrastructure for the massive wave of demand that is coming in 2027, 2028, and beyond. If you stop building new stores now to protect your short-term SSSG, you will completely miss the wave when it crests.
So the thesis for investors is endure the pain of densification and capital expenditure now in order to harvest the free cash flow later.
Correct. The entire industry is shifting. It's moving from a land grab phase to an efficiency phase. That's why we're seeing mergers to create leverage. That's why we're seeing energy-saving broilers to cut costs. The growth at any cost era is officially over. The profitable, efficient growth era has begun.
Which brings us to the final verdict. If I'm a Druva investor listening to this and I've absorbed all this detail, what are my key takeaways? What should I be tracking for the rest of the year?
I'd say three big things. First, the Devyani Sapphire merger is a game changer specifically for their leverage against aggregators. Watch their gross margins and their other expenses line over the next 18 months. If they can successfully squeeze Zomato and Swiggy for better terms, you'll see it there first. That's the proof of the thesis.
Okay, that's takeaway number one. What's number two?
Number two is that the resistance is real, and it's being led by Jubilant and Westlife. Their investments in direct channels, their own apps, their own delivery fleets, their loyalty programs are the most critical metrics to track. Ignore the headline revenue number for a moment and look for the percentage of revenue that's coming from their own digital channels. That number is the true measure of their survival and long-term success.
And the third takeaway.
Efficiency is the new alpha. RBA proved it this quarter. In a high-inflation, low-growth environment, the company that can relentlessly cut costs, energy, waste, supply chain, without hurting the core customer experience is the one that will generate free cash flow and outperform. Look for operational leverage.
Excellent. I want to leave our listeners with one final provocative thought to chew on. We've spent this entire deep dive talking about the QSRs fighting the aggregators, but my question is, are Zomato and Swiggy just aggregators anymore?
No, they're not.
They're launching 10-minute grocery delivery. More importantly, as you mentioned, they're launching their own private label food brands. They have the data. They know exactly what burger you buy, from which brand, at what time of day, and at what price point you're most likely to order.
And they can use that data to manufacture a near-identical copycat burger in a dark kitchen and have it delivered to you in 10 minutes from their own delivery fleet.
Exactly. So my question to you, the investor, is this. Are the QSRs fighting a battle for better commission rates? Or are they fighting a much bigger war for their very existence against a platform that is slowly but surely becoming their biggest and most dangerous competitor? If Zomato becomes the McDonald's of the cloud, what is the terminal value of a Westlife or a Burger King?
That is the multi-billion rupee question, isn't it?
Yeah.
The line between being a platform and being a competitor is dissolving right before our eyes. And that is the single biggest risk and opportunity in this entire sector.
On that cheery note, we'll wrap up. This has been the deep dive on the Indian QSR sector. Check the transcripts, look at the own channel revenue mix, and please don't get distracted by the short-term noise. Thanks for listening.
Keep analyzing, keep learning. Goodbye.